and a MACD indicator, and this video is going to be on something called divergence. Now, divergence refers to when price and momentum are starting to diverge. In other words, momentum can't keep up the same type of strength that price has. So for example, price is rising, and you can see the momentum based upon the histogram. The bluish bars here on the MACD has been rising, but sometimes what happens is you get another rise in price, but the histogram doesn't follow suit. So what I mean by this is that this is a slightly higher high, and you can see as I draw the line here that we made a fresh new high over here, but notice how the histogram is nowhere near being that high, and what that suggests is that perhaps the momentum's slowing down. We just don't have the type of momentum underneath the instrument to continue to move higher, and you can see exactly what happens. So typically what happens, or the best way to trade divergence at least, is to find it on an oscillator. It doesn't have to be MACD. Some people will use the RSI or the CCI, but it's all the same thing. You're looking for the momentum to slow down while price is rising, and typically you'll marry that with a candle. In this particular case, we had a little bit of a shooting star on the daily. You can see that we are running out of momentum. That was a very good sign to start shorting. Now, divergence in and of itself isn't always a signal to go in the opposite direction, but a lot of times it gives us a little bit of a heads up as to what may happen. You want to use it with a candlestick or some type of pattern or something that the divergence confirms it, to trade it just from divergence. Although successful in the longer term, it's much more reliable if you use price action or some other type of system as well. But it does make a great secondary indicator. A lot of traders will pay attention to it. That being said, you have to keep in mind again that nothing's perfect, and on the higher time frames, the higher the time frame, the more reliable it tends to be. So again, divergence is just simply momentum not following what's going on in the chart. So it does work in both directions. So for example, if we were to get a much higher reading here, for example, that might have been a divergent sign, because as price is going down, momentum's going to the upside. And in this case, in the example that I've shown you, momentum was going down as price was going up. So it shows you that underlying something's not quite right. You got the candle that showed signs of weakness as well. And on a breakdown below there, a lot of people probably would have jumped on this.